Hello there and welcome to myfinanceteacher.org. Let's have a look at a fundamental valuation of another couple of interesting miners here, and we're going to look at Agnico Eagle and GoldFields. This evaluation is based on the recently published Q4 2024 numbers. As usual in our model, we look at discounted per share value after all-in sustaining costs, long-term debts and taxes. And in our model, we only look at proven and probable reserve as well as half of measured and indicated resources, without taking into account any of the inferred resources, never mind any of further exploration success. So to the extent that the market price might actually correctly value some of the future potential success, the fundamental valuation presented here might be different. But as you see, we like to lean conservative here by looking at relatively more established reserves in the ground. And of course, the data that we plug into the valuation model includes the prices of gold, silver and copper, the amount of reserves and resources in the ground, the costs of extracting those reserves. We look at all-in sustaining costs, we look at long-term debts and taxes. Of course, we look at per share value with a discount rate of 5%, and we have a bit of a secret sauce on insider shares, as larger percentage held by insiders helps to align the incentives of the management with those of the regular shareholders. As usual, we're going to look at three scenarios for gold price, and over the next several months throughout these videos we'll try to stick to the same numbers. The conservative scenario plugging in the gold price of 2200, balanced scenario 2600, and optimistic scenario only $3,000 per ounce. Starting with reserves and resources in the ground and the costs of extracting those resources, let me first mention that the numbers coming up and down with these arrows is the comparison of current Q4 numbers versus the same numbers in Q3 2024. So for example, gold proven and probable reserves with Agnico Eagle, which is at 54.3 million ounces right now, has increased by over 3 million ounces compared to the numbers we discussed last quarter. P&P reserves of silver have dropped down to 53 million ounces, and P&P reserves of copper increased a little bit to over 1.5 billion pounds. M&I resources, that's measured and indicated resources, are nearly 43 million ounces, while M&I resources of silver are at 60.5 million ounces. Both of these M&I resources declining a little bit, while the M&I resources of copper have increased to 242 million pounds. All-in sustaining costs have risen by $50 an ounce, and the current guidance for 2025 suggests the midpoint of $1,275 per ounce. Moving on to GFI, they have over 44 million ounces in P&P reserves of gold, 46 million ounces in reserves of silver, and 247 million pounds in copper reserves. Gold resources are at over 30 million ounces, and silver resources are at nearly 3 million ounces. Again, you see the changes compared to the numbers we discussed in the previous quarter, and we see a larger leverage to gold price as demonstrated by higher all-in sustaining costs at $1,575 an ounce according to the guidance for 2025. Moving on to finance and time value of money, the long-term debts for Agnico Eagle are almost unchanged at over $1.15 billion. Agnico Eagle has over 502 million shares outstanding, and 0.06% of those shares is in the insider hands according to Yahoo Finance. For time value of money, I'm going to use a discount rate of 7%. And again, in relation to that time value of money, mine life is at 16 years if you're looking at reserves only. Adding only half of M&I resources extends the mine life to around 23 years. Cash is not explicitly in the model, but we'll look at the amount of cash as an additional risk metric, and Agnico Eagle has $926 million in cash. For taxes, to simplify the process a little, I'll just assume a flat tax rate of 25%. Moving on to GoldFields, their long-term debt has increased by nearly $1 billion up to $2.14 billion. Their shares outstanding is almost unchanged at 895 million shares outstanding. Average mine life of reserves is at 19 years, Adding half of resources extends that to around 26 years at current annual production. And GoldFields has $860 million in cash. Next, before moving on to the most interesting part of this valuation, let me remind you to join us at myfinancesteacher.org, where we regularly publish the best uranium reports on the internet. I'm certain that uranium is gonna get hot over the next few years. Talking about energy, we've recently discussed a very intriguing cash cow, which is relatively affordable with a relatively small market cap. If you're interested in dividends and share buyback programs, you might find some interesting ideas at myfinancesteacher.org. And of course, perhaps one of our most interesting categories is this category of juniors in metals that are going to perform outstandingly well once the sentiment in the actual miners as well as the developers reflects what has been going on to the gold price itself. And talking about juniors, we've recently looked at some of the major developments with Nevada King. For all those details and much more, make sure to join us at myfinancesteacher.org. Now, coming up to our valuation numbers, let's start with the conservative scenario where we'll plug in the gold price of only $2,200. Think of this scenario as simply an indicator suggesting what might happen to the share prices if gold price just say drops out of bed here. And in this scenario, we only plug in the proven and probable reserves in the ground without taking into account M&I resources, never mind inferred resources. This gold price and the reserves in the ground, given the previous numbers, implies a valuation of nearly $46 for Agnico Eagle and nearly $12 for GoldFields. Next, looking at the balanced scenario, we plug in the gold price of $2,600, and even in our balanced scenario, we only look at the proven and probable reserves in the ground without any of the M&I, never mind inferred resources. And this gives us a discounted per share value after all-in sustaining costs, long-term debts and taxes. Basically our valuation for Agnico Eagle, fundamental valuation, of over $66, whereas our fundamental valuation for GoldFields is at over $20. Finally, and most excitingly, looking at the optimistic valuation, we plug in the gold price of only $3,000, so we're not overly optimistic here. And in this scenario, we look at the value of proven and probable reserves as well as only half of measured and indicated resources, without including any of the inferred resources. This gives us a discounted per share value after all-in sustaining costs, long-term debts and taxes of over $111 for Agnico Eagle and over $35 for GoldFields. Agnico Eagle is in fact not really far from these numbers. It's at around $105 at the moment. And traditionally AEM, Agnico Eagle, does of course get a huge bump thanks to very talented management that has later done a good job to acquire more reserves at an acceptable cost. So I suppose we shouldn't be discouraged by the optimistic valuation being pretty close to the current market price in case of Agnico Eagle. If the positive management bias persists in the future, you might easily bump up this valuation number as well. And talking about this number, how high do you think the share price of Agnico Eagle will go before some sort of a sell in May and go away takes place? Let me know down in the comments below. While you're there, remember to hit the like button and share this video with your friends. Have a wonderful Wednesday. Bye bye.